Take a look at the stock market today. By many metrics, it's overvalued. That doesn't mean it can't persist, but it certainly means that we have been overdue for more than just an aggressive, volatile market, unchanged in value for a year and a half. The Fed has done everything in its power to try and magnify the prices of all goods and services, and has done so. Inflation has picked up in everything from tuition to electricity to just about everything else. Something is definitely wrong, and there's no telling how widespread the effects will be. You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening in the bond market. This is very important, and I know that I have been stressing this recently because of the yield curve inversion, because of everything that has been happening in the stock market, but people have taken their view away from the bond market, screaming, "Look out below." Let's get into it right away. This is the first of many charts I'm going to show you. I couldn't believe it. I had to look at them 2 and 3 times to believe that this was actually happening. The global negative debt is now $16.7 trillion worth. It has gone absolutely astronomical just in 2019. If you look at the trajectory, it is going off the charts. There's no telling how much negative debt can actually be created, and there is no way to ever come back from this. The problems that they've created are permanent. It cannot be resolved by printing more money, adding more debt, creating more of a deficit issue. This needs to be resolved by what I call the economic detox. They're not allowing that to happen, and the average person thinks that that's a solution to print more money, to add more debt, and to kick the can down the road. They thought that it was actually resolved back in 2008, but we are still dealing with the effects today. Quantitative easing maybe got the assets to increase in value, or I should say price, but it is actually creating a bigger crash at some point down the line. I don't know when it's going to happen, but it's going to be created specifically because of central bank activity. Just look at what is happening in the bond market, $16.7 trillion worth, and that number is increasing on a daily basis. Distribution of euro investment grade corporate bond yields and the share of the euro $2.2 trillion market with yields below zero. It's broken down here, but as it's highlighted, you can see the negative yields, and a lot in terms of percentage. You can see 30% in this case here, the short end being negative yield. You can look at Switzerland's down at the bottom. I'm going to show you some more charts in a second here that break it down a little easier to see, but this is just showing you every step. Non-US dollar investment grade fixed income yields approaching zero. This blue line is the US investment grade fixed income yield, and the orange line is non-US, and that is simply going down to absolutely nothing. That connects in with this next chart here. The US share of global investment grade fixed income yield has reached 94%. So this data here, whichever you look at, it's simply showing you that in the United States, you're getting some yield. If you go practically any other place around the world, you're getting nothing or negative. That's what we're dealing with right now. Now, the yields in the United States are declining as well, but at this moment, that's basically the only place where you're actually going to get some sort of return. You have to go out 100-year Argentina bond if you want to get some yield. If you're going to the supposed safe countries, let's say Germany or Switzerland, even if you go all the way out, you are not going to get any yield whatsoever. In fact, it is negative. The market is completely broken. A lot of people ask about this and the repercussions of doing this. It means that it is broken. There's no way that it can ever actually reverse this without what I call the economic detox. If they're not going to let that happen, they are going to create a bubble so big we have never seen anything like this before. Proportion of bonds trading in negative yields in the JPM GBI VI Broad Index. Do you see a pattern along this chart here? Basically everything is 100%. Once we go into the 10 plus years, it starts to be a different story. But look, Denmark, Germany, Netherlands, and Finland all have 10 plus years, 100% all the way through basically. No matter where you look, the yield is essentially nothing or negative. Imagine the level of risk that we are encountering today. This is going to create a big issue for the bond market, but also what it's doing is forcing a lot of investors into equities. Not when you look at the fund flows, the EPFR data, not when you look at the actual big institutions, because these people are putting their money into the bonds. That's why a lot of this is happening today. But I'm talking about the smaller investors where they don't really realize all the implications of the central bank policies. So they're taking their money and they just put it into equities thinking, well, I've seen the stocks go up before. This is certainly the time to invest. I'll buy the dip. I'll do this and that. But of course, that could prove to be a big mistake. Banks' net interest income as a percentage of assets. You're looking at the 12-month trailing net interest income, whether it is Japan, Switzerland, Euro area, Denmark, and the US. You can see the trend since the financial crisis. It has been heading down, down, down. We've watched as the central banks have been reducing their interest rates, and this has been going on, of course, all around the world. The impact of their policies are felt outside of their borders. One central bank starts to reduce interest rates, and they say, well, we got to do the same over here. We got to do the same thing as that country, and this country, and that country, and they're all going and spiraling downward. Take a look at the euro money market volumes. You can see what had happened ever since they implemented negative interest rates. Nobody wants to touch this stuff. The money is fleeing. Why? They need yield. They need to find safety, and they are not finding it either in the secured or unsecured. That's the two different colors here. And unfortunately, for all of those who are getting themselves into riskier investments as a result, maybe it's derivatives, maybe it's the CLOs, CDOs, subprime something or other, derivatives that we've seen before or new ones that have been created since, it doesn't matter. The risk is being taken right now, and unfortunately, that risk will take them. Bond weights of the G3 pension funds and insurance companies, we're looking at Japan, Euro, and the US. Big difference in between these. Japan has been seeing this percentage go higher and higher. In this case here, it is approximately 65% of their total assets. United States looks like it's down around 35% or so. So there is a big gap in between these two. The Euro area, it has declined somewhat over the past few years, but it's still at approximately 60%. When you have negative yielding bonds, what do you expect to see the results of? How can you get those returns when everything you're investing in has a negative yield? This is a big problem. I want you to pay close attention to what's happening, not just with the US pension funds, but look at the others around the world. My goodness, this is very dangerous. You've seen the shortfalls that have been happening in pension funds all around the world, but we've covered it oftentimes from Illinois and other states, and it's the same problem. They expect a certain target, let's say 7%. We're going to give you 7%. We can do it. The market increases by 7%. We will match the market. We'll do a good job. And then you watch as the underfunded pension liabilities grow further and further, and people don't really know what's going on. As long as they get their check, they're fine. But suddenly they encounter an issue. We saw the former governor of California suggest that they will actually need to cut pensions during the next recession. He has made that a public statement. Here we are today facing a crisis that the majority of people don't even realize could happen. Of course, it's going to happen, whether it's in the next crisis or a future one. This is certainly something that is very huge. Equity allocation of Japanese public versus private pension funds as a percentage of the total, you can see that there is a big difference here. The private pension funds, this has been declining for years and years. It is now down to less than 10%. When you look at the public pension funds, this is around 20%. And I just wanted to cover two more things before I finish this video. We're also heading into a tough season for the market. September and October tend to be the most volatile of the year for markets. We've been talking to investors for that reason to look for areas to prune risk within a portfolio. People should be reanalyzing their portfolio instead of simply adding more and more and more. I think it's an opportunity for individuals to simply take a look and reflect on what has happened so far, and ultimately do what you think is right. At the bottom here, they made another comment I thought was interesting. What's been abnormal is the super low volatility that investors have been enjoying for much of this bull market, which began in 2009. This is abnormal. That's the whole point here. We've seen everything flipped on top of its head. Now, some people out there acknowledge this and they say, I understand everything is screwed up. I understand that the Federal Reserve has created this big bubble, but they're not going to let it crash. The elite did this, the elite want that, and therefore they're not going to let it crash. Therefore invest, therefore you don't know what you're talking about. These people here are over leveraged and they are making a big mistake. It doesn't mean you should do this or that with your portfolio. It doesn't mean that you shouldn't have something. Whatever you want, you have to do it. But you need to be able to manage risk. And the average person, they can't do that. They always take things too far and then they are really in big trouble sometimes. And unfortunately for so many, they end up in dire straits. Last but not least, S&P 500 valuations. Borders denote metrics trading above their historical average. Just take a look down the list. It's all of them basically, except for two, 18 out of 20. Whether we are looking at the different PE ratios, the earnings, the S&P measured in other things like WTI or gold, it is showing an overvaluation here at this time. That is something you cannot ignore. That's all for this video. If you found it informative, hit that thumbs up button. You have to support this channel. Help me out. Just click one button. I do appreciate that very much. If you want to be able to sell on Amazon, to make money, to create a passive income business that works when you sleep, I have a free e-course. You don't pay a dime. All you got to do is go to the amazongps.com, sign into the course. It's through teachable.com, completely free. I put everything together for you so you can learn step by step. Link will be in the description. I hope you take advantage of this. And of course, if you want the financial education that wasn't taught to you in school, these two books have exactly what you need. Whether you're talking about the foundation, the history, the asset classes, how to make money, it's all in these two books. If you want the audiobook, that's available at themoneygps.com. Have you seen what China has done? If not, definitely watch this video, click on it, and I will see you over there.